Hello and welcome back to The Note. There's been great concern about recent political events in Russia for obvious reason, and that's had a big impact on Russian share prices. But is there something broader at work across emerging markets and concerning investors' attitude towards state control in emerging markets? Are people beginning to learn something new about political risk in the emerging world? With me to discuss this is the Chief Emerging Market Strategist for Deutsche Bank here in London, John Paul Smith.
Hello, John.
John Paul, thanks very much for joining me today. Let's start by taking a look at what's been going on in the Russian stock market. Obviously, Russia is acutely tied to the oil price. It's a petropower. What's going on now?
Well, what's really been happening is something that's been happening for quite a long time. In fact, since late 2003, to be precise.
Well before we all started worrying about the Crimea and Ukraine, in other words.
Absolutely. Late 2003, if you recall, was when Mikhail Hodorkovsky was arrested, and effectively the start of the UKOS dismembering process. That's when the state started to increase its influence over both the Russian economy and the Russian equity market. And the result has been that compared with the oil price, which overall has been relatively buoyant over that period of time, and which Russian economy is heavily reliant and dependent on, Russian equities have actually been a poor investment relative to where they would have been had the policies between 1999 and 2003, which were much more capital friendly, been carried on.
Okay, so this is driven, in your opinion, by poor corporate governance. This isn't a question of stocks now being cheap. They're cheaper than other stocks because they should be, because of governance issues.
Yes, absolutely. I mean, they're the cheapest in emerging markets, and for that matter in the world, both on replacement cost and also on earnings, for very, very good reasons. And those reasons are that effectively value has been siphoned out of most of the major stocks in the Russian index by various means, but the biggest diversion away from minority shareholders has undoubtedly been this expansion of state power, which has meant that the government's been able to act in a very arbitrary way, and we've seen that on repeated occasions. What's happening in the Ukraine really is just a further illustration of the sort of effect that Russian government policies can have on the equity market.
Okay. Strong words. Let's take a look. One point that you've made in your research, which is fascinating, is that Russia is nowhere near alone in this. What we're showing here, the red share of these bars is the proportion of the index for each of these countries that is state-controlled. You can see that China obviously has a big red bar, but Brazil is comparable to Russia as well.
Yeah. Well, look, state control per se is not necessarily a bad thing. In fact, we saw during the financial crisis that actually a lot of emerging markets and emerging economies were relatively resilient precisely because the state was more proactive than it had been in the developed economies and markets.
Particularly China's stimulus.
Yes, although in retrospect that was a huge policy error because of the size of it and the distortions that it introduced into the economy.
But it made people happier at the time.
No, it seemed to be a stabilising factor. The point is that since the great financial crisis, the lesson a lot of emerging market governments appear to have learned is that the market and so-called Anglo-Saxon modes of corporate governance are not what you want to follow. In other words, this idea that over time emerging market governance will converge with that in developed markets, I think, is now outdated. And we've been discussing this for 3 years, but it's taken a while for the market to cotton on to that. I'll just make the point that over the past 3.5 years, emerging market equities have underperformed the US by about 65% in dollar terms.
Okay, now you've got fascinating research which suggests that that's been largely driven by negative sentiment towards state-controlled companies, that previously there was this sense of an inevitable convergence with Anglo-Saxon models, whether you want to call it Fukuyama-esque end of history ideas or whatever. And it's in these last 2 years that you've seen that belief really radically changed. Is that a fair assumption?
Yes, that's a fair assessment. And actually the poster child for that is Brazil. I mean, Brazil in the second half of the second Lula administration and the Dilma administration, effectively you've seen the government in effect come after almost each of the big sectors in the Brazilian equity market, with the exception of the consumer sector. More importantly, across virtually every single emerging market that I look at, the increased intervention of the state in the economy has reduced the medium-term rate of sustainable growth by reducing productivity. And again, Brazil is a very good example of that.
Okay, so one last very quick question, big question, but quick. Does it still make sense to talk about emerging markets as one big asset class then?
No, I don't think it does, and in a way, I don't think it ever has done. They used to discuss them, of course, as less developed markets, and that might be a more sensible way of labelling them. But I think for investors, the lesson is clear. For investors, don't use benchmarked passive vehicles as a way of getting access to emerging markets. Look instead for absolute returns over a period of time, and above all, take into account contextual factors. In other words, don't assume that it's inevitable that frontier will outperform emerging, which in turn will outperform developed markets, because that implies an inevitable convergence, which is unlikely, unfortunately, to be the case.
Okay, John Paul, thank you very much indeed. That was perhaps in some ways a grim assessment, but it's also a realistic one. There are plenty of pockets of value out in the emerging markets, to use that word for want of a better phrase. But again, a lazy assumption that everything is going to converge in a particular way is not going to help make money.